Have you ever thought about how many shares are just sitting idle in your Daymod account? Maybe you've invested in some good companies for the long term, but apart from waiting for the stock price to increase or receiving an occasional dividend, those shares don't really do anything. Now imagine if those same shares could start earning you extra income without you having to sell them. Sounds interesting, right? Well, that's exactly what today's video is about. We're going to understand something called the stock lending and borrowing mechanism, or simply SLBM. Many retail investors don't know this facility even exists, but institutional investors and professional traders have been using it for years. By the end of this video, you'll know exactly how it works, who borrows your shares, why they borrow them, how you get paid, and what risks are involved. Let's dive in. Imagine there's an investor named Neha. She's been investing for several years and owns 2,000 shares of XYZ Industries. She's confident in the company's future and plans to hold those shares for at least the next 3 or 4 years. Since she isn't planning to sell anytime soon, those shares are simply lying idle in her Daymod account. Now let's meet another market participant. His name is Karan. Unlike Neha, Karan is an active trader. After studying the charts and market conditions, he believes that XYZ Industries' share price is likely to fall over the next few weeks. He wants to profit from that expected decline. But there's one problem. He doesn't own any shares of XYZ Industries. So how can he sell something he doesn't own? This is exactly where the stock lending and borrowing mechanism comes into the picture. Neha logs into her broker's SLBM platform and decides to lend her 2,000 shares for a period of 1 month. She specifies the lending fee she expects to receive. On the other side, Karan places a borrowing request for exactly the same number of shares. Once the exchange matches both orders, the transaction is approved. But before Karan receives the shares, he has to deposit collateral with the exchange. Usually, this collateral is worth more than the market value of the borrowed shares. This protects the lender in case anything goes wrong. After the collateral is deposited, the borrowed shares are temporarily transferred to Karan's account. Now Karan can execute his strategy. Suppose XYZ Industries is currently trading at 800 rupees per share. Karan immediately sells all the borrowed shares in the market. A few weeks later, the stock falls to 740 rupees. Karan now buys back the same number of shares at the lower price. Since he sold high and bought back lower, he makes a profit from the price difference. After that, he returns the shares through the SLBM platform, completing the transaction. Now let's look at what happened to Neha. Did she lose ownership of her investment? Not at all. She continues to remain the beneficial owner of those shares. At the end of the lending period, the same number of shares is credited back to her Daymod account. On top of that, she receives the agreed lending fee. In other words, her investment generated an extra source of income without her having to sell a single share. That's one of the biggest advantages of SLBM. Now you may be wondering, what if the company announces a dividend while the shares are on loan? The good news is that the lender continues to receive the economic benefits associated with owning those shares. Similarly, if there's a bonus issue, stock split, or other corporate action, the exchange follows a structured process to ensure the lender receives the appropriate benefits according to the applicable rules. But short selling isn't the only reason traders borrow shares. Let's look at another example. Suppose a company's futures contract is trading at a price lower than its cash market price. Professional traders often take advantage of this price difference through an arbitrage strategy. They buy the futures contract while borrowing shares through SLBM and selling them in the cash market. As both prices gradually converge, they earn a relatively low-risk profit. This strategy is widely used by institutions and professional market participants. Now let's talk about why investors like Neha choose to lend their shares. The first benefit is obvious. Instead of allowing investments to sit idle, they earn additional passive income. Second, they don't have to sell their long-term holdings. Their investment remains intact. Third, because the entire process is managed by the stock exchange, the risk of default is significantly reduced. Everything is backed by collateral, margins, and a regulated settlement mechanism. Of course, there are risks too. If the borrower fails to maintain sufficient collateral, the exchange immediately asks for additional margin. If the borrower still fails to meet the obligation, the exchange conducts an auction to recover the required shares. Any additional cost arising from that process is recovered from the borrower. This is one of the reasons why the lender's risk remains relatively low compared to lending shares privately. It's also worth remembering that SLBM transactions aren't completely free. Your broker and the exchange may charge brokerage, transaction fees, and other applicable charges. These costs vary depending on the broker and the duration of the lending contract. Another important question many investors ask is about taxation. The lending fee earned through SLBM is generally treated as business income under the Income Tax Act. That means it is taxed according to your applicable income tax slab. If you're planning to participate regularly, it's always a good idea to consult a qualified tax professional. So what's the biggest takeaway from today's video? If you're a long-term investor holding quality shares for years, SLBM gives you an opportunity to earn additional income without selling your investments. At the same time, traders gain access to shares they need for strategies like short selling and arbitrage. It's a regulated system where both parties can benefit. Like every financial product, you should first understand how it works before using it. Know the risks, understand the costs, and only then decide whether it fits your investment strategy. I hope today's video helped you understand the stock lending and borrowing mechanism in a simple way. If you learned something new today, share this video with another investor who probably has no idea that their idle shares can actually generate extra income. And if you want more videos on investing, personal finance, stock market concepts, and wealth building strategies, don't forget to subscribe to Retail GoPro and turn on notifications. Now, here's a small challenge for all of you. Let's see if we can make this video reach 1,000 views. If this video reaches 1,000 views, I'll make a complete follow-up video where I'll share a step-by-step roadmap on how to earn passive income using SLBM. In that video, I'll cover how to start lending your shares, which brokers support SLBM, how to calculate your expected lending income, which stocks are most in demand, common mistakes beginners make, and strategies that experienced investors use to maximize their returns. So if you don't want to miss that video, subscribe now, turn on the notification bell, and share this video as much as you can. Thanks for watching, and I'll see you in the next video.